Scott's joining us live from the floor of the Chicago Mercantile Exchange. Scott, we had some interesting developments overnight, and I want to get your take on how much you think they could impact financial markets. First, the U.S. sanctions on Venezuela. Is this more a discussion we should save for our energy discussion in the next block, or does this impact the U.S. dollar and other foreign currency markets?
Well, I can certainly weigh in on it, but, you know, at this point, I think the sanctions are nothing more than rhetoric, quite frankly. Let's see what actually plays out with this over the next week or so. I'm not sure how much that these sanctions actually directly related to the dollar weakness, the dollar softness that we're seeing, which I think is coming more from, you know, the anticipation of what the Fed is going to say tomorrow.
So, Scott, you sent in your notes some comments about the euro currency and why or how it's been holding in a tight range. Talk to us about some options which are set to expire. Looks like about $6 billion worth between 114 and 115.
So really, really interesting. You know, the Eurozone has been, you know, their economy has been so weak and there's been lots of pressure. But that range-bound price that you're talking about versus the dollar, the 114, 115, it's almost like if you're talking to someone that trades equity options, when you talk about a stock being pinned right at a strike, meaning that there is massive amount of open interest in a particular option strike. Well, that's the case here with the euro. Between 114 and 115, like you just mentioned, Ben, there's $6 billion, $6 billion US dollars worth of options expiring this week. That always puts a big pressure on the stock, or in this case, on the currency, on the underlying, because there's so much pressure, there's so much push and pull at those numbers. That is one of the reasons why we're not seeing the euro actually go lower on their terrible economic news, and why it is range bound until these options come off.
Yeah, we're watching. It certainly has found some support around that 114 handle. Scott, we were just talking about the U.S. sanctions on Venezuela. You said wait a couple days, or a couple weeks actually, let's wait and see as this develops. But we have another story that's been playing out here. The U.S. has filed criminal charges in 2 Huawei cases, and they seek extradition of the CFO. I understand this could be a fly in the ointment as far as U.S.-China trade talks are concerned, but what are the implications for the U.S. dollar and other foreign currency markets?
Well, what you're seeing is, you know, let's call it a little bit of a flight to quality to the yen. That's why you're seeing a big rise in the yen, because, you know, there's pressure on the dollar. There's pressure on other currencies that are known as the let's call it the riskier, the risk-on assets, such as like the Aussie dollar. People are selling the Aussie dollar. People are selling the U.S. dollar. They're going to those safe havens like the yen. That's why you're seeing it pop up there.
So, Scott, another big day for the UK, the EU. We've got the whole Brexit negotiation process continuing to play out. Parliament is set to bring forth what could be key amendments to Theresa May's divorce deal. One's expected to soften the backstop concerns. The other's intended to delay Brexit or avoid a hard Brexit trajectory if there's no deal by some point in February. Do you feel we've moved away from the edge? And does it appear that the UK falling off the edge into a hard Brexit is becoming less and less likely by the day?
Well, from the psychological and emotional side of that trade, yes, I do. I've tried wrapping my head around what's going on there, Ben, you know, quite frankly, and I am just, my head is spinning trying to grasp really what is going on there. But what I will tell you is, you know, the longer this goes on, the less and less, I don't want to say the less important it is, but the less impact there seems to be on the pound, on the sterling, as some of that emotional pressure gets taken off the marketplace.
Yeah, certainly as traders, we've become a bit more callous to some of the ins and outs and the ups and downs. Scott, with the Fed set to announce tomorrow, there's a lot of attention on the U.S. dollar. It's been coming off some. Should we be expecting this to continue if the Fed remains somewhat dovish?
Yeah, I think actually any surprise in the dollar, Ben, may be to the upside. I know I'm the contrarian there, but, you know, the market and the media is really expecting, and traders are expecting, a continued dovish rhetoric out of the Fed tomorrow. And I think that the dollar maybe has gotten ahead of itself a little bit in anticipation of those talks. So even if we see Powell and the rest of the Fed come out and say, yes, we're going to continue on this path, you know, we're leaving rate hikes, you know, behind right now. We don't know what's going to happen. I think we may have seen a short-term bottom in the dollar here.
So Scott, once we get past the Fed tomorrow, the focus is going to quickly shift over to U.S. jobs report scheduled for release on Friday. Last month we saw a blowout number to the upside. Non-farm payrolls came in above 300,000. I think it was 312. We had unemployment at 3.9%. Participation rate was at 63.1%. I think most feel these are somewhat lofty and probably unsustainable. Do you?
Yeah. No question about it. I can't imagine that we're going to see those numbers again, and that's not necessarily a bad thing. That doesn't mean that things are have gone south here at all. I think that the last month's numbers that we saw may be one of those outliers, and we'll probably get somewhere back to the norm on this one.
All right, Scott, one more question before we let you go and let you out of here. I'm wondering if you've been watching the Treasuries and how after the spike that we saw in December to the upside as the indices, as stocks were selling off, as the indices have been rallying back, the Treasuries have really yet to decay or come off that upper level. They're still, for the most part, holding upper level price activity. I wonder if this is kind of pointing towards, or if this is showing us that investors, well, basically, if the market is not feeling that pressure from the short side of the Treasury market. So again, if you remember, for many months into the end of 2018, it was the short side that was leading lower as the Fed was, well, had their foot on the gas pedal. But as they've eased off a little bit, I wonder if this is kind of added to some of that dynamic as Treasuries, at least the longer end, the 10 and the bonds, have really yet to pull back or come off, even as the indices have rallied back.
What it really tells me, Ben, is that there's confusion across the space in the marketplace, across all asset classes, whether it's equities or treasuries, because, as you said, you usually see those, work conversely with one another, and they've really been holding in there. The treasuries have been holding in there. So I think that investors and traders don't really know what to make yet of the rally we've seen over the last 4 weeks, and then also what to make of the Fed. And I think we'll start to get a lot of clarity, not only this week with the Fed speak, but over the next couple weeks as earnings, we're coming into the big, robust part of the earnings cycle right now. It'll wind down in the next couple weeks. We'll see what happens with China, which should direct also what the Fed may do. So their next speak after this one could be quite different than what they say this week. So I think we got to give that a couple weeks and see if it starts to go back more into line with its normal pattern of trade.
All right, well, something to watch here, Scott. A lot going on, and that's why we asked you to join us this morning to help us make sense of it all, and much appreciate your time here today. Traders, that's Scott Bauer. He's the CEO of Prosper Trading Academy.